BRRRR program is great. It's different loans, obviously, but the objective is get in with high leverage, implement your value add strategy, and then force appreciation, refinance it to a 30-year fixed rate, either portfolio or small balance agency debt, which is non-recourse, but you have to meet the thresholds. Or if you don't meet the thresholds, then we look at bank or credit union. So there's four options right there.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello and welcome to another episode of the Investor Financing Podcast, and I'm your host, Beau Eckstein. And today we're going to talk about multifamily bridge to BRRRR financing. And I want to talk on properties that are smaller unit count. So typically 10 units or less, anywhere from 5 to 10 units. You can do them with a little bit bigger unit count too, but primarily I like to keep these at 10 units or less because it gives us a little bit more financing on these bridge to BRRRR structures. So this is a really good structure for investors that are on the up and coming. They're doing, they're not syndicating deals typically. They're investing, on sub $1 million properties or maybe sub $2 million properties, depending if they're buying on the West Coast versus the Midwest. But here's the strategy. We have some of our funds or debt funds will lend up to 80% of the purchase price and 100% of the CAPEX on these smaller multifamily deals. And then what I like to do is after you implement your value add plan, you raise rents, you implement the CAPEX budget and strategy. Now you stabilize the property, you force appreciation. Instead of going bank, where you might be getting a 5-year fixed amortized over 25, maybe possibly 30 years, there's now the portfolio lenders that have aggressive pricing, and you can actually get a 30-year fixed rate starting in the mid fours, anywhere from mid fours to 5.25, depending on LTV. So in theory, doing this at year 4 or 5, you don't have to look to refinance, which 4 or 5 years from now, rates are going to be up. So if it's a long-term hold, this is a great strategy. You can, on a cash out refinance, you can go up to 75%, assuming the debt service coverage ratio is in line and it's 1.25 or better. So this is a great strategy for small multifamily properties. You can get high leverage bridge funding. It's typically a 12-month term. Some bridge lenders can do 18 or 24 or 36 months, but typically it's 12 to 24. They do sometimes build in extension periods for the bridge debt, but usually bridge is really supposed to be short term to get the property stabilized. So the bridge to BRRRR program is great. It's different loans, obviously, but the objective is get in with high leverage, implement your value add strategy, and then force appreciation, refinance it to a 30-year fixed rate, either portfolio or small balance agency debt, which is non-recourse, but you have to meet the thresholds. Or if you don't meet the thresholds, then we look at bank or credit union. So there's four options right there. So that's basically on the exit. We look at, what the vision is, how long you're going to hold it. If you're only planning on holding it for a few years, we sometimes look at credit unions. Credit unions oftentimes don't have prepayment penalties. So there's just a lot of ways to work it, but I just want you to get thinking about how to implement these smaller multifamily bridge to long-term and how to BRRRR them, BRRRR 2.0. Anyway, thank you for watching this episode, and I will see you on the next one.